exercise 6.9 in your text, this is labeled problem number 7 in Connect. This is the last one for this chapter. I know you're really disheartened by that. Anyhow, they say this is the information. Take a look at the information. We're given the direct materials, the direct labor, the variable manufacturing overhead, so using just variable costing, it's $40 for the price of the unit, okay? Does that add up to 40? No, it adds up to 45. Sorry, I can't do math. I went to Philadelphia Public Schools. So, that's all the information. If they use absorption costing, this is the piece we're going to have to think about. So, let's see what they tell us. Compute the unit product cost for year 1 and year 2, and prepare an income statement for year 1 and year 2. Well, okay, we can do that. That's not so tough. Year 1, the direct materials are $25 each year. The direct labor is $15 each year. The variable manufacturing overhead is $5 each year. And using real math, not Philly Public School math, my variable cost per unit is $45 each year. Okay, so we did 1A already. That wasn't so bad. Now let's do 1B. It's really not so bad. It's just more writing. But we can do it. We're Temple tough. We can do this. Okay, so let me get my notes. Go back to the problem. Walsh produced 50 units and sold 40 in year 1. So year 1 they made 50, sold 40. And in year 2, and let me highlight that in some color that we can. So in year 1, first year, produced 50, sold 40. So that's year 1. And year 2, and we'll do that in pink, it produced 40 and sold 50, and no matter which year they sold them, the selling price was $60 per unit. See, clever, use both colors for this common selling price. Okay, so let's take the information that they've given us and make some accounting sense out of it. It's not such a big deal. This is year 2. Okay, so year 1, they sold 40,000 units at $60 per unit. Per unit, that's $2 million. $400,000. The variable cost of goods sold is 40,000 units times $45. So that's 1,800,000. And if you think I'm working these numbers out in my head, you're crazy. I did this before I started filming. And the variable selling and administrative, this is the only one I could do in my head, 40,000 units, $2 per unit, 80,000. So the total variable expenses, 1,880,000. Therefore, the contribution margin is 520,000. The fixed manufacturing overhead is 250. Remember, we need to subtract that. And the fixed selling and administrative is 80. So altogether, that's a total of 330. We subtract the 330 from the contribution margin. They're the two numbers we care about. And the net operating income, 520, take away 330, 190,000. Year one. Okay? Now remember, year one, we made 50, we sold 40. Year two, we made 40 and sold 50. That's not going to matter under the variable costing. It will matter when we do the absorption costing method. So remember, this year they sold 40,000 units. So the sales were 40,000 for year one, 50,000 for year two. So 50,000 units times $60 per unit. That hasn't changed. So we have to take 50,000 units times $60 per unit. It's $3 million. The variable cost of goods sold, 50,000 units times $45 per unit, $2,250,000. 50,000 units times $2 for the variable selling and administrative. Again, that's one I can do in my head. $100,000. So the total variable expenses for year two, $2,350,000. By definition, sales minus contribution margin. Sales minus contribution margin. Minus variable cost gives us contribution margin, and that contribution margin is $650,000. We still have the same $330,000 of fixed costs. And our net operating income is $650 minus the fixed cost contribution margin. By definition, those funds that can be used to cover fixed cost, $320,000 for year two for 50,000 units in sales. So, that's part 1, A and B. Here's part A, here's part B. Now, it says, but wait, I'm not done torturing you. What happens if the company uses absorption costing? I'm sure you were sitting there thinking that same thing to yourself. I could hear you all saying to yourself, "Self, what happens if they use that one that I really don't understand?" Well, let's work with it and let's see if we can get you some more understanding on it. And remember, everything stays the same, except we now have to consider the fixed manufacturing overhead. We have to worry about our numbers in the little blue box. So what we have to do is in year 1 and year 2, we have different amounts of the fixed overhead applied to each unit. Because in year 1, we made 50,000, and in year 2, we made 40,000. So all of this stays the same, but we have to fuss with the fixed manufacturing overhead, which is $250,000. So the direct material stays the same. 25, 25, 15, 15, 5, and 5. Now we have to do the fixed manufacturing overhead. So year number 1, we have $250,000 in fixed manufacturing overhead. Remember the number in our little blue box, 250,000. And we're saying for that $250,000 in fixed overhead, we made 50,000 units. Therefore, each unit had about $5 in overhead. So we have to add the $5 and the absorption costing unit per product. Instead of being 45, is 50 in year 1. Okay, so that's year 1. Now, year 2, remember we made 40,000 units. So in year number 2, we still had that 250,000 in overhead, but we only made 40,000 units. So that's roughly $6.25. I think it's exactly $6.25. So we have to add that to year 2, and our price per unit for year 2 is $51.25. And that's because in year 2 we only made 40,000 units. And so year 2, our price per unit is higher than in year 1. You can think of it as the penalty for not producing at full capacity. However you want to think of it, however you can get it into your head, is what I need you to do. Now it says, okay, you did that. Now let's do an absorption costing income statement. We did the hard part, by the way. This was the hard part. Seeing the difference in the price caused by the units produced. That was the hard part. So, there's the absorption costing income statements. And let's go through and do those. For consistency, I will stick green for year 1 and pink for year 2. Okay, the sales remember haven't changed because sales don't change depending on what method you use of costing. You still sold what I forget what the number was already. 40,000 units. But year 1, we sold 40,000 units at $50 per unit. Those 40,000 units under absorption costing, we're costing them at $50 per unit. So when we do that, the sales are still 2,400,000. That's $60 per unit for 40,000 and $300,000, $60 per unit for 50,000. The cost of goods sold is what's different. So the cost of goods sold for year 1, we have the 40,000 units that we sold times the $50 per unit. $50 per unit. That's 2 million rather, sorry. Remember, this is the traditional format, so we don't have contribution margin, we have gross margin, 400,000. We have 160,000 of selling and administrative expenses. That was the information they gave us to start this home mishigas. And that gives us net operating income of 240,000. Now, year 2, remember, we sold 50,000 units. So year 2, we sold 50,000 units. So we have to take that 50,000, and our cost per unit is $51.25 because we made fewer in year 2. We sold some that we made from the year before. We're using some of that overhead from the year before. So it's $51.25 per unit. So year number 2, we sold 50,000 units. Okay. So we sold the 40,000 that we made at $51.25. Plus, remember, we sold 10,000 that we made at $50. That's the key that you have to remember. You can't say you sold 50,000 at $51.25. You didn't. You only made 40,000 at that price. Likewise, you can't say you made 50,000 at 50 because you didn't. So you have to keep track of that. It's kind of like the LIFO FIFO thing. You just have to remember to do it. When you do that, that comes to $2,550,000 as the cost of goods sold. $2,550,000. Now the gross margin is 250 is the 3 million minus the 25.5 gives us 450,000. Now remember, we have selling and administrative expenses, and because we sold more, it's now up to 180 because of that variable selling and administrative. 180,000. Do I have enough zeros? No, need no zero. So our net operating income is 270,000. So that's 2B. And then the last thing it asks us, part 3, it's basically saying, okay, I see what you're doing, but why? Why is it different? And the difference in the operating incomes are simply caused by the fact that you made more than you sold one year, and the other year you sold more than you made. So you had different costs from year to year. So let's do this, and we'll do the entire statement. And I think by the time we're done, you should be pretty okay with this. So the units in the beginning inventory in year 1 was 0. And in year 2 was $10,000. In year 1 we produced 50,000. In year 2 we produced 40,000. In year 1 we sold 40,000. In year 2 we sold 50,000. At the end of year 1 we had $10,000 in inventory. At the end of year 2, we had 0. So, now let's take a look at the fixed manufacturing overhead in each year. Fixed manufacturing overhead in the ending inventory for year 1. We had 10,000 units left over. And remember, that year we said we had $5 as part of the fixed manufacturing overhead that we were storing, we were putting to inventory. So we had that $5 per unit. So that's $50,000 in inventory of fixed overhead from year 1. In year 2, because not only did we use up last year's, but we sold all that we made, we had nothing in ending inventory. So that made that easy. Now, we need to figure out the fixed manufacturing, the beginning inventory. And in year 1, it was 0. And the ending inventory for year 1 is the beginning inventory for year 2. So the total manufacturing inventory that was deferred, we deferred 50,000 in year one because we had that stored in the ending inventory. But in year two, we used it up, so it was gone. Now the variable costing net operating income, that was one of the very first sheets we did, which I've probably lost already. Anyhow, the variable costing net operating income for year one was $190,000. Okay, there we go. Net operating income, 240 minus the 50, because we're going to adjust it for variable costing. So we have to subtract out that 50 to make it variable costing. Get rid of the fixed portion. So that's 190. And variable costing, we have to add that 50 back. So instead of it being 270, we have to add that 50. So that would make it 320. Because remember, we're going to strict variable costing. Now, we want to get rid of, because what we're doing here is we're explaining the difference. So we're saying this was what the absorption costing variable income was under absorption costing. The difference is the blue box. It's the piece of the fixed overhead. So if we want to go to strict variable costing, we have to correct out that error. So we need to subtract the 50 from here. We need to add the 50 to here. Because here we have $50,000 more in expenses and fixed overhead, and here we have $50,000 less because they're left over from last year. So if we're going to add this to come up with variable costing, which we would, it makes it 240. And if we're going to go to variable costing, we have to subtract the 50 because we handled that last year. $270. And that's the income. They're the income numbers that we came up with when we did it. Okay? So we just have to take the absorption costing, eliminate the effects of the deferred fixed overhead to get variable costing. It's not difficult, it's just detailed and kind of weird because you have nothing like this in the real world, in people world. This is not something that you have any referent for in your world. And to tell you the truth, I don't think I've had more than a dozen clients over 40 years who have used true variable costing. They use absorption costing for a variety of reasons, not the least of which is that's what's required by the IRS for tax reporting.